Hi everyone, we are here with Anthony Clark, also known as Smalltalkdaily, and we'll just be talking about all things JSE shares. Watch till the end. We're gonna talk about the PSG Unbundling. We're gonna talk about Libstar, KaapAgri, and Stadio. So, Anthony, thanks so much for being here. For those who don't know Anthony, I'm guessing many of you do. He's also a mentor on the FinMap app, posts regular updates there and awesome educational, informational knowledge on JSE shares. Anthony, thanks for being with us.
So, thanks, Higgo, and hello to the FinMap audience. It's nice to be back.
Awesome. So let's get into it. So PSG unbundled their shares. This is not a thing we see every day. Tell us more about the unbundling and just, what should investors look for now? So let's say somebody had their PSG group shares and now all of a sudden they just see KaapAgri shares, they see Stadio shares. What does it all mean and what should investors look for?
Yeah, it's been a very fascinating event in the market the last week and a half. PSG announced their unbundling in March this year with the son of the founder, Piet Mouton, deciding that he wanted to delist the company to take the market sight off a company which has actually underperformed and hasn't done a great deal of new investments for quite some years. Now, let's not forget that Piet Mouton, who's a famed businessman in this country, took a small company valued at maybe 10-15 million rand in 1996. And at the peak of its valuation, if you include the Capitec stake, was worth nearly 60 billion rand. You've never seen such wealth accumulation in this country in recent memory, apart from maybe if you invested early on in the days in Nationale Pers or maybe Rembrandt. So a staggering amount of wealth has been created by one individual, which his son is now basically dismantling. So on Monday, if you're a PSG shareholder, you'd have woken up and your broker would have told you that you've got shares in varying ratios in Curo Holdings, the private education schooling company, in Stadio Holdings, the tertiary schooling company, in CANS, which is an African-focused, fast-moving consumer goods distribution business, in PSG Consult, which is an asset management business, and latterly in KaapAgri, a nationwide agricultural and retail operation. And many people, even my institutional clients, were scratching their heads saying, well, what are these companies? What should we suddenly do? Because those companies, to a certain degree, are not very well covered by the institutional sell-side analyst segment. I've been covering many of these stocks for the best part of 20 plus years. So none of this came as a surprise to me regarding the market's reaction regarding we have a large liquidity event. Lots of shares are going to be unbundled to the market. What do we do with them? Do we hang on to them? Do we reallocate them or do we sell them? And that's what we've seen this week regarding the extreme volatility and the above average trading in many of the shares. As one example, KaapAgri on its first day of unbundling traded at 14 times daily average volume. CANS sales was trading at several hundred times its average daily volume, as all of its shares were suddenly flopping around the market and people needed to decide where to go. So I'm sure your next question is going to be, which ones of those stocks would you hang on to and why?
Exactly. So some of those shares I own, well, mainly one, and that is Stadio. But, I'd love to get your take, because personally, I also don't understand all of those companies. So, what are some of the companies that you currently own and tend to own for the long term and which not?
Yeah, well, I've owned KaapAgri for a long, long time. I first picked up coverage of that company 17 years ago when it was a backwater Western Cape agricultural company beginning to transform itself under the guidance of PSG or Zeda Investments. And I think the current unbundling by Zeda in February this year and then PSG latterly has really weighed on the share price, where the share price year to date is down 25%. Now, many of your listeners would think, well, why the hell would I want to be invested in a share where there's been, a downward pressure? And I'm saying, well, sometimes the markets just do not keep on going up in a straight line. We have to live with volatility. We have to live with significant events which only happen perhaps once in a generation, which is what the PSG unbundling has been. For the best part of 20 years, the ownership of KaapAgri has been basically sewn up amongst a handful of very large institutional investors and PSG. we now have a company which has seen a 42% increase in its underlying tradability because of a PSG unbundling. That's 32 million shares that have suddenly hit the market. That has caused extreme pressure on the downside, because again, think of it logically. If you were a hedge fund or a trader, knowing there'd be an extreme liquidity event, you would sell the share short, hoping to buy it back at lower levels because you were getting the stock anyway from the unbundling. So that has been quite prevalent in KaapAgri. The underlying earnings of the company have actually been extremely good. At the interim stage in March 2022, earnings were up just over 15%, which, in this environment where retail companies are showing you pretty miserable underlying growth, for an agricultural and retail hybrid like KaapAgri to show a 15% rise in interim numbers is actually, I think, pretty great. They recently came up with a 10-month trading update for their September year end. So it's a 10-month update, and that's going to be up between 16 and 21%. And I'm convinced they will have a revised trading update ahead of their actual results presentation in November. So on a midpoint HEPS, you can see KaapAgri probably trading at a 7 times PE, which is one of the lowest ratings I've seen for this company for the last 10 years. And that is purely due to the compounding effect of a liquidity event and the uncertainty about where all the share is going to go to. Now, if I look even a year forward, the underlying agricultural sector is doing fantastically well, and I'm forecasting another very good 2022-2023 agricultural season. Despite all the impacts we know of rising input costs of fuel, chemicals, diesel, freight costs, etc., farmers will still make good money. If farmers make good money, they spend, which is why the capital equipment sales lately have been extremely good for the last 2 years. And despite the underlying costs of producing maize, wheat, citrus, apples, table grapes being up year on year, the weakness of a rand and the demand globally for product means the farmers generally are still making money. The citrus market is not making as much money as they should, but they still need to export. And if they need to export, they still need to export using specialized packaging. They still have to grow the fruit. It has to be harvested. It has to be stored. It has to be, it has to be fed with nutrients. So they still have to buy the stuff. So I had somebody arguing with me yesterday saying, well, the citrus farmers will not make as much money. They won't. But to get to that point of actually having an orange, they'll still have to actually, grow the product, provide fertilizer, look after the plant by the packaging to export it. So at the end of the day, the co-ops still make money, even if the farmers don't, because, they just make less money as a farmer. So in KaapAgri's case, they're doing fantastically well. And I'm forecasting a minimum earnings to September 2023 of R6.50. It'll probably be better than that, which brings the PE down to about a 5.5. Now, with a 5.5 PE and a 6% dividend yield, you would be crazy not to want to own a company which has had a consistent 15-year track record of delivering earnings growth apart from a COVID blip. Now, you show me a retailer which has had such consistency trading on a 5.5 PE and a 6% dividend yield. You will not find it. So to me, KaapAgri at 38 Rand is a compelling buy for any long-term investor looking to position themselves in a well-run company in the agricultural and the retail space, which has an astonishingly good track record.
Awesome. That will definitely look, I don't know, it's that cheap and with such a good dividend yield. So that's definitely something to look at. Another company which I personally own, and I know you cover it as well, is Stadio.